Okay, hi guys. So in this video, I'll be teaching you guys easy step on how to day trade or how to day trading in forex trading. Okay, in 2020. Okay, first and foremost, I know there are some of you out there using the MetaTrader software, which is another software, which is it's also display the graph, but I prefer to use TradingView because it offers more tools. It offers a replay button. It offers indicator in which inside the MetaTrader did not offer. Okay, and then when it comes to the difference between MT4 and TradingView is that TradingView lets you have a full control, and then it looks more modernized compared to MetaTrader. Okay, and for those who don't know how to use MetaTrader, this right here you have a watch list, and this right here you have alerts. This right here you have all the news, all the headlines on the certain currency pairs. This right here you have a data windows, and this is not actually important. This is right here is a hot list. This also is not something. If you trade stocks, then this might be important to you. But as for me, I trade forex trading, so all I need is my watch list. This is all the currency pairs that I trade. So all the ideas, I don't post any ideas on my trading view. I post all the results on my Instagram, so you guys can check out on the Instagram for all my recent entries on GBP pairs, on the rest of the pairs. And this is where all the chat that you have among the TradingView community. You have the private chat, idea streams. This is where people post their ideas. And one key note to remember is that although you have all these ideas came up to you on this trading view, do not take all of them. Okay, if you, let's say at the beginning, I prefer you guys to make your own mistake. I prefer you guys to make your own analysis. You may watch all this analysis idea just for you to get an idea how do people make their analysis. Okay, do not try to copy what they did without understanding. It's just for you to help to understand why did their analysis, why did they draw the support and resistance on a certain level. Okay, and these are the notification. If you have any alerts on the your graph, then this right here will have the notification. And this right here, dom is basically the strength of the market. The buyers and the sellers are coming in, and as you can see, the red one is the sellers, the blue one is the buyers, and the white one is where the price is in between of them. Okay, it's called the spread. It's not the spread, it's just the price gap in between sellers and the buyers. Okay, um if you open a dom if you open this dom segment, when it comes to news, then you can see that all these numbers are going to ov- are going to be more stronger than others. Sometimes for the yesterday, where the US got an election, you see that this blue color spikes until here. Okay, the volatility is a rise. Okay, it's a lot. Now that you see there's a lot of white right here, it indicates you that the market doesn't have that volatility. Okay, dom I don't actually use. I just i just like it's just there as an extra features, but I don't actually use. I use in market structure. I'm explaining to you guys. The only thing that you need is watch list and alert. That's it. Okay, watches and alert. Other than that, you can use to your advantage, to your arsenal. It all depends on you guys. So here we have all the tools, and as you can see, if you mark the stars right here, you can put this you can put these tools inside this down here below, so that you don't need to, each and every time you need to use something, you don't need to open it and press it. Okay, understand? But these are the tools that I use. Okay, these are the position. Okay, the short position and the long position. These are the short for the sell position, and the long is the buy position. Horizontal line is basically horizontal line. Trend line is trend line. It's a line that you can draw in whichever direction you want. Fibonacci extension is basically the one that I use for my takes profit. Fibonacci retracement I don't actually use. It's not that I don't know how to use. It's just that from my past I don't get a really good entry when it comes to Fibonacci retracement. So this rectangle is just a normal rectangle. This rectangle, it's equipped with how many pips, the number of pips. As you can see, the moment I go down, the further I go down, the number is increasing. So this right here, you can basically adjust. You can basically know how much that particular area is, how many pips, like this area. So you don't need to calculate from here. So it will make your job much more easier. Okay, as you can see, this market is going down. If I see right here, we both know that it hits trend line, breaks down. This is double bottom. It's going to break. It's going to retest maybe, or it's going to go straight down. Okay, it's very simple. These are the indicators, and you can enter maybe RSI, maybe moving average. I only use moving average, exponential moving average. And this right here, you can set everything, maybe 50, maybe 21, maybe 9, maybe 12, maybe 5. It's all up to you. Yeah, so that's it. This right here are the numbers, and you have all this difference of the chart that you can use. Maybe you can use a Heikin-Ashi, or maybe you can use a halo candle. It's up to you, but I prefer to old school Japanese candle. It's I've been using for the past years now, so it's gonna be hard for me if I change. But I do sometimes use line chart to make my area more precise. And this right here are the time frame, are the time frame lah, multi time frame. Okay, and you might this, from what I had just explained to you guys, is just the basic on how to use TradingView. Okay, now I'm going to explain to you guys the basic when it comes to forex trading. Okay, this right here is your multi-time frame. Okay, this right here is your best friend. As you can see right here, it says right here one month. So which means this one candle represents as 1 month. Okay, it will close each and every month, and same goes to weekly. On weekly, this one candle right here represents as 1 week. Okay, if we go right here, okay, as you can see, 1 week, this is 1 week candle. Oh, it's haven't closed yet, sorry. Okay, this is 1 week candle. This is the 1 week candle. Each and every week it will form a new candle. That is the basic stuff. Okay, sorry, never mind. And as for the D1, as you can see right here, we have all this calendar news. I set it to the high impact and the medium impact so that I can be ready. It's either for me to avoid it, or it's either for me to trade with it. Okay, it's just for me to be alert, on that particular moment that there is news coming into the market. Okay, and as for now, same goes to the D1. This one candle represents as one day. Okay, this one candle is 1 day. Like you see right here, 7 August, 6 August, 5 August, 4 August, 3 August, and 31 July. Okay, and as for the H4 is basically 4 hour. This one candle represents as 4 hours. Okay, your 4 hours, in which this one candle is formed as at 1 a.m. or 1 p.m. It depends on where you live, or it's a 1 a.m. 1 a.m. in the morning. And this one candle represents as 9 29 29, in which if you convert, which will be 9 p.m., this will be 5 p.m., this will be 3 p.m. Okay, this will be is 1 p.m. It's 13. So this one candle represents as one H4 candle. Every time the candle has reached its limit of 4 hours, it will close and it will form another candle. Same goes to the H1, same goes to the 30 minutes, same goes to the 15 minutes. As for the H1, same as before, same as the D1, the daily, same as the H4, 4 hour. This one candle represents as 1 hour. Okay, within 1 hour, this candle is going to move. This 1 hour, this candle is going to move, and then after 1 hour, it will stop. And then it will create a new candle. So this might be your 1 p.m. This might be your 12 p.m. This might be your 11 p.m. Okay, that's for 1 hour. Each time frame has their own characteristic. Okay, the lower you go, you will see a lot of noise. The lower you go, you might see like this, like this, like this, and then like this, like this. But on the H4, but keep in mind this might be M5. Okay, but on the H4, it might look like this. It's very simple. Okay, it's very different. That's why I always tell my students to always rely on the higher time frame, because the higher time frame it's going to give you a better entry and a better picture in the market. Okay, whatever fake outs that happens on the lower time frame, example like this. How about I erase everything? I'll just redraw a proper chart draw. It might be like this, and then it drops, and then it goes back up, and then it stops right here, and then it goes back up, and then like this, it stops, and then it goes, and then it goes, and then it goes, and then it's come back, and it goes. Okay, this might be M5. Okay, and on the H4, it might look like this. Simple. This is on the H4. Okay, like I said, I always tell my student to always rely on the high time frame. It depends on which time frame that you rely. It might be on the H4 or it might be on the H1. It all depends on your comfortability. Each technique has their own ways to apply on the chart, right? So each human being has their own ways to apply their own technique, right? Okay, so as you can see right here, this is the basics. Okay, do not confuse when you go to the lower time frame. You might see a lot of wicks. Okay, a lot of fake out. You might be asking what is wicks and what is fake out. Okay, example, this is an uptrend candle. Okay, I'll change it into a color that you will understand. Okay, this is an uptrend candle. Okay, as you can see, it's same as mine. This is an uptrend candle. This is a Japanese candle. Okay, like I said before, this is on the H1. After 1 hour, each hour, the market will form a new candle. Okay, the market will form a new candle, and then it will keep on moving in the new direction, or in the same direction, or in a down direction. Okay, as for the Japanese candle, let's say the market open, let's say it's 2 o'clock, sharp 2 o'clock, and then the market form a new candle right here. Okay, and this is the open price. Okay, as for the uptrend candle, the open price must be at the lowest, must be right here. Okay, the open price has to be right here. Has to be open. This is where the new candle, the new area is formed right here. Okay, and then it goes up. Okay, and then it comes back, and then it left you wicks right here. Oopsie, right here. Okay, it left you wicks. Okay, this might be 2 o'clock. Okay, and then when you look at the when you look at your watch, it might be 2:59 p.m. So there is 1 minute left to close, and then it's still moving, and then the moment your clock shows a 3 o'clock, then it will stop. Where it stops is where you put, this is where the close price, okay, this is where the close price happens, and the new price and the new candle will form. It might be somewhere here. Sorry, I'll put it on the other side. Okay, and as for the new candle is formed, the price will open right here. Okay, it will always open right here, and this right here is a wicks is actually, wicks or shadow is what people call a history of the movement of the market. Okay, on the like I said, you will see wicks. Okay, this is all the wicks. This is where the market has go up and get rejected. Okay, the price that they go to being rejected by all the big traders, by all the big bank. Okay, and then they got pushed back, and then the price closed at this area. Okay, and this one candle is formed on the hourly chart. Okay, on the H1 chart. Okay, if you go on the M1 or if you go on the 15, it's still the same thing. um, Inside this week you will see a lot of maybe this movement, and then it spikes and then it comes back. Okay, there's a lot of things happens on the lower time frame on these weeks. Okay, this is just the basics. And then when the market is open right here, maybe it goes down. I'll change the color first, and then it goes down like this. Okay, the first candle is going up, but second candle, it's going it's going down. Okay, it's going down like this. It's going down, and then it's going down maybe like here. Okay, maybe it left you a little bit wicks, small wicks. Okay, like I said, this right here, this starting point right here is open. Okay, it is your open. Okay, because it closed on the previous candle, it closed right here, so it has to open at the same level as the close. Okay, it doesn't matter, the candle might go up, it might goes up, or it might goes down. The open price of the new candle is always going to be the same level as the previous price that being closed. Okay, it's simple as it is. It's very simple. I hope you guys understand. Simple like this. And then when it stops at a certain area, because of due to the time, the candle has stopped. Where it stops is where you know that this is the closing price or the close candle. Okay, like I said, it might be up here, and then it stops right here, and then this is your close. It just depends. Okay, and then it close. Okay, simple. And then the new hour came by, and then this is your open price, and then the market has moved like this, and then it leaves you wicks right here. We do not count the wicks. Okay, the wicks is a history of the market movement. It's the past history of the market movement, so that we know uh, there are rejection on that particular area. That's why it left you wicks. Okay, and then it close like this. Okay, it opens here, it opens here, opens, and then it close right here. Okay, it's very simple. This is a candlestick, Japanese candlestick. I hope you guys understand. The open price has to be the close. The open price has to be the same level as the close price, and the wicks is actually the the history movement, the past movement of that particular candle. Okay, this all wicks right here that you see right here is a history. Okay, the market has tried to go up, the market has tried to go up, but then it got rejected. And then it comes back down, and then oopsie, come back down, and then it opens. It closed here, and then the new candle opens at the same area, at the same level as the closing price, and then it close here, and then it opens on the B side of it. Okay, it's just, this is the basic candlestick. You don't need to get stressed about it. I know there are a lot of candlestick pattern, and to be honest, for the past years I have been trading, I don't actually focus a lot of it. I know there are hammers, I know there are shooting stars, I know there are doji. Okay, you don't, if you focus on that candlestick pattern, you are only focusing on this, let's say, on this particular area. Okay, with my trading style, I like to focus on the bigger picture so that I know what are the future big movement. I don't actually watch on this just particular one small movement, because it's not going to give me enough confirmation for me to entry. Okay, I think that's it. I hope you guys understand. Multi time frame, as I said before, I know we all know, we are going to see the chart like this. We know that this is an uptrend. Okay, but if we go on the low time frame, we can see that there's a lot of high highs and high lows, high highs and high lows. We can see a lot of wicks, we can see a lot of body, we can see a lot of candlestick pattern form on that lower time frame. That's why I always stick on the high time frame, example as a H1, for you to have a cleaner chart, for you to have a precise entry, a precise confirmation, so that you don't get confused. Okay, it's very simple, wicks and the body. And then as for the market, there's only three ways for the market to move. It's either it move like this. This is a sideways movement. Okay, sideways movement is basically a consolidation, whether the bears and the bulls are trying to compete which one is stronger within which one. Okay, example as for the GBP JPY, British pound is currently fighting with Japanese yen. Okay, British pound is currently fighting which one is stronger than the Japanese yen. If you see right here, it's uptrend. When that particular pairs is going uptrend, it basically indicates that the front of the pairs is going uptrend. Okay, is stronger than the back. British pound is stronger than Japanese yen when it's uptrend. Okay, but when you see a downtrend like this, this basically indicates you that Japanese yen is stronger than the British pound. It's simple, is it? If it's uptrend like this, it tells you that British pound is stronger than Japanese yen. If it's downtrend, then it tells you that Japanese yen is stronger than the British pound. Okay, and then like I said, if you see sideways like this is basically both currency have the strength, have the same strength. Okay, and another movement, it will go like this, and you guys know that it's an uptrend. Another one will be like this. I'll erase this first, so that another one will be like this. This will be your downtrend. Okay, the market will only move in this particular direction. Okay, I have not seen the market move in a way that other than this tree. Okay, it's always gonna do this tree movement. Okay, it's very simple. And then for the market, it will move like this: higher high, higher low, higher high, higher low, higher high, higher low, higher high, high low. Okay, I'll put it HH, high high, and then I'll put it one more right here, higher low. Okay, high high, higher low, high high, high low. Okay, this one is high high. Why is it I call high high? Because this high is higher than this high. Okay, why did I call this a higher low? Because this low is higher than this low. That's why it calls higher low. That's why this calls higher high, higher high, higher high, higher low, higher low. Okay, and then maybe one day all of a sudden the market is starting to lose the power, the strength, and then it starts to do like this. It starts to do like this, and it starts to do like this, and then it goes like this, and then it goes like this, like this, like this, like this, like this, like this, like this. Okay, this this movement right here is what I call a reversal movement. Okay, I I do teach my student how to trade this reversal movement. I actually have two type of entry, where the first one is a high risk entry and the second one is the low risk entry, so that no matter where the market is, I will always have my entries. Okay, it's just the difference is whether the entry is a high risk or the difference is low risk. Okay, this is a market reversal. First thing, it forms a high, which is as you all know, this high is lower than this high, but then all of a sudden this low, I'll put it, this low, this low right here is almost the same level as this right here. Okay, this low right here has broken this higher high before. Okay, this this area right here has broken this higher high before. That's why we consider it as a lower low. Okay, before this you see that it forms, this low is higher than this low, but it's above than this higher high right here. See, it's above this higher high right here, and then all of a sudden this low is breaking this higher high right here, and then it stops right here. It's almost near. Sometimes it can be somewhere around here, sometimes it can be shorter, but the rule is, in order for this market to be a lower low, it has to break this higher high right here. Okay, it has to break this higher high right here, and then this one we don't consider it as a higher high, we consider it as higher low. Higher eh low, I'm sorry, lower high, I'm sorry, lower high. Okay, lower high, lower low, same rules apply. Lower high, lower low, lower high, lower high, lower low. So is lower high, lower high, lower low, lower high, lower low. Why does it call a lower low? Because this low is much more lower than this lower, and this high is much more, this lower high is much more lower than this high. Okay, it's very simple. This is an example of this market reversal. And this right here, as you can see, this is a head and shoulder pattern. This is where you see most of the time the market head and shoulder pattern will oftentimes be formed. If it forms on the high time frame, example on the D1, on the H4, the H1, the movement of the reversals is going to be big. Okay, it's going to be really big. Another movement, another pattern that oftentimes people use is basically double bottom, triple top, and head and shoulder. These three pattern are the most head and shoulder, double bottom, triple bottom. Okay, I know there are a lot of names, there are a lot of terms names when it comes to these three things, but as you guys know, head and shoulder is basically head, shoulder. This is sorry. I'm bad at drawing. I'm so sorry. This is head and shoulder. This is a double bottom. This is triple bottom. Okay. Reason why I call it triple bottom because it has a three touches. A double bottom is basically a double bottom. Head and shoulder is basically, it looks like head and shoulder. Okay, shoulder, head, shoulder. If you don't have any clear picture, you can just Google it and you will see a lot of pattern. You see a lot of examples of it. As for the, I hope you guys understand on this market, higher high and higher low. Like I said before, this high is higher than this high. That's why it calls higher high. Okay, and this low is higher than this higher low, higher high, and higher than this higher low. That's why it's called higher low. But the moment it breaks this higher high, then is this will consider as a lower low. Okay, and then the new high that it forms, it will be considered as a lower high. It will no longer form as a higher high. It will form as a lower high. Okay, you might be, if you are beginner out there, I suggest you guys to avoid this reversal pattern because it might confuse some of you guys. Let it move a little bit, maybe somewhere around here, then you can entry. And then when it comes to entry, there's a lot of technique there is in the market. Example, support and resistance, and then trend line. Okay, as for the support and resistance, we can see right here there is a zone. I will normally combine support and resistance and zone. It will be much more easier for me to understand. This right here, there is a zone right here, and you can see, okay, the moment we know that this zone is strong when we see there's a lot of rejection on this particular area. Okay, and then for this, I know, and for this we know that this is a sideways movement. As you can see, the market is moving sideways. Okay, even if we open our indicators, it will show that it's struggling with the moving average. If we see a clear healthy trend, we can see like this, a clear healthy trend, like this, a clear healthy trend. But the moment the candlestick struggle with that moving average, we know that it's a sideways movement, or in other words, it's a correction movement. Okay, let's play a little bit. What are we going to do? Okay, I see this is a possible entry. Okay, it broke this minus support and resistance. It comes back and retests. Stop loss will be around here. Keep in mind, this is a sideways movement, which can be very, very dangerous to most people. It might go against me and retest back to this area. It's just we have to be careful. Okay, as we can see, this is a really, really great example of, do not simply place your trade based on just one confirmation. Okay, see, let's see if it hits our stop loss or it doesn't hit. Okay, let's see if it's go to our take profit. Oh, nice. Okay, and then it goes even more. See, on this area right here, it's our zone right here. It's very simple, zone to zone. Okay, I know that we have a little bit floating right here, we have a little bit negative floating right here, but in the end of the day, we managed to close our profit ratio to 1. Ratio 1 equals to 2.5. Okay, which is 700 pips in just one day with GBP JPY. Okay, and then let's see if we can get another entry. Trend line is basically like this. See, one of the reasons why I place my buy right here is because it breaks this support and resistance, and then it comes back and retests, but it retests a little bit further than I expected. But never mind, it's always happened in the market. And then as for the trend line, the reason why I didn't include my trend line as my confirmation, because it's already broke the trend line. Okay, the market is here. There's no reason for me to draw the trend line here, because the market is here before this. Okay, I can't draw this trend line like this. I have to draw it like this. Okay, it has to like this, high low, right? You have to draw like this. Okay, but the moment the market starts to do like some kind of reversals like this, and then it shoots down like this, you cannot draw your like this. Okay, it's already reversed. This is a lower low and this is a lower high. Okay, your trend line has to be on the higher high, higher low, like this. Higher high, high low, higher high, high low. It breaks and it retests, and then it continues with the movement. Okay, and you don't need to always watch the chart. You have, when it comes to trading view, you have all these tools in your arsenal. Example as alert. You can just put alert. Oh, you can just put alert right here when the market is retest like this. Is retest your area like this. You can notify on you. It will tells you, all right, traders, all right, guys. The market is testing your area, so you know what to do. Just put an alert, a reminder of you guys that the market is at area where you mark your zone. Okay, there's use an alert. As for an indicator, I told you guys this is where you find your indicators. These are the time frame. These are the types of charts that you can use. If you want to use all this, I don't use all this. I think you have to pay for the fees, I guess. And then we can see, okay, it starts playing. We can sell if you want to sell. This is a fake up movement. Let's see on the high time frame. Keep in mind this is sideways. I don't want to take a risk. It's too much risk. Let's see. I'm aiming for the market to going down. I'm not going to entry, but I'm aiming for it to go down. Let's just see. Okay. Let's see. Oh, then it spikes. Right. Spikes. Okay. It plays. Okay. It forms another. Okay. It forms another area right here. Forms an area right here. Okay, I understand. Okay. Now let's see. See what happens. It spikes. Okay, it breaks. It fakes out. This is a break. It's true this is a breakout, but it's also a fake out. It breaks one time and it breaks. It comes back again. Okay, never mind. Let's see. Let's draw a trend line. Let's draw a trend line. I'm still with my analysis that tells me that this is going to go down. I'll just put my drawing right here so that you guys can see the chart. Okay, and then let's see what we're going to do. Okay, this is the last retest. If I open a line chart, I can see that it's retesting. Okay, I'm going to take the risk to place my entry right here. My confirmation are going to put a really small stop losses, 300. Okay, my confirmation are the candlestick is at my area. Okay, the candlestick is at my area. It's starting to show a lot of wicks. It's starting to show a lot of candle, a lot of small candle, in which in my understanding, in my trading technique, I know that this is a correction movement. This entire area is a correction movement. So this right here is a confirmation, one confirmation that it will reverse. This is the last touch. This is quite strong area. First it touch and then it reverse. It touch again and reverse, and then it tries to break. It did a fake out, and then let's just see what happened. Okay, it does goes up a little bit. I don't mind if I hit the stop loss. Oh, okay, I hit a stop loss, so never mind. It goes much more higher. Never mind, we learn from our mistakes. Plus it's very small stop losses. Alright, it comes back to my area. Let's see what happened. Shoots back up, plays on that area, and then it breaks. It tries to break, and then it tries to break our trend line. Okay, so right here, this is a quick example on maybe our stop loss or take profit can be right here. Show. Let's see. Never mind. It hits our stop losses. Never mind, because it's too small. If we increase our stop losses somewhere around here. This is I'm showing you a really great example. What will happen if you choose to trade within the sideway area. Okay, within the area of the sideway, it keeps on playing in that particular zone, even though it has broken our trend line, and then it breaks, and then boom, starts to go down. Okay, when it comes to, and then it comes back. See, oh, I cannot erase this. Okay, and then it comes back, it breaks our area, and it comes back, and then we can place our another entry right here. Example entry. This is only example entry. Maybe our take profit will be somewhere around here. Let's just see. And then it shoots back up. It starts to play again. Then it plays again and again. Don't worry, we're strong. Don't worry, we're strong. See? Don't worry. And as for those that I know that some of you, when it comes to GBP/JPY, it's very volatile. It's one of the most volatile pairs there is in the market. So I know there are people out there who are going to say it's a very dangerous to trade this pair, but let's just see on the high time frame what we're going to do, what it's going to do. Oh, I see. Okay, it's true that it's going up against our direction, but you have to understand this entire movement right here is basically a correction movement. Okay, this when it comes to correction, this is what you will see in terms of fake out, in terms of the high volatility. Okay, you just need to know how to avoid it. Okay, and then it starts going down. Overall, we still profit on this particular trade. On this two trade, we only had one losses. We can erase this area right here. Can erase this right here. There are zones right here. We need to draw zones. Okay, this area right here is still fresh. Okay, let's just see. Okay, it's a really good trade setup. We will place right here. Our stop losses below the lows, below here, and then I'm gonna show you how. Okay, it might be your take profit might be 1 equals to 2, or 1 equals to from this zone, or maybe 1 equals to 3. Okay, it all depends on how you put your stop losses, how many take profit that you want. And as you can see, the market is going into the direction that you want. Okay, it's very simple. I just shown you guys a live example on how how dangerous it is to trade during the sideways movement. Okay, I'll show you another example when the market is fresh trend. Let's see what it's going to do. Never mind. This is a quick retest of this particular area. And we put a long position. We place right here. Our stop losses can be huge, but I'm fine. This is H4. We don't know what will happen. Our take profit can be 1 equals to 3. Okay, let's just see. Fingers crossed. Let's just see what happened. Alright, it goes in our direction. Okay, simple. Zero float, or some of you might call it a sniper entry. Okay, this trade right here, sniper entry, is when you have a healthy trend. Okay, a healthy trend. What I just shown you guys before this, during this particular moment, is basically the sideways movement. Okay, it is what that you will see when you place your entry. The market will either hit your stop losses or it will hit your take profit. Okay, because it is in the sideways trend. It is what, like I said before, when when the sideway trend has happened, this both currencies at the same strength level. Okay, this both currencies at the same level, so it can spikes, it can reverse, it can catch your stop losses. Okay, and basically a lot of things can happen. And for the beginner out there, uh, I suggest you guys to avoid correction movement. Okay, I suggest you guys to avoid trading correction movement because it's going to be a pain in the ass if you trade them. Okay, like I just showing you a real example. Okay, we have two trades. We have one, two, three right here. I remember four and one losing trade. So we have four winning. Two of them is basically during that correction movement, and two of them is basically during that healthy trend movement, and one I lost the trade. Okay, this is a very quick example. Okay, I just explained to you guys how to use a trading view. I just explained to you why the basic of the market structure. I just explained to you guys support and resistance. Support and resistance is basically in an area, a sensitive area where the market reverse, where the all the big bank or the hedge fund trader is placing their big order on that particular area, and we have the market pattern. As for the take profit, it's very simple. It all depends on your comfortability, your comfort zone, your goals. My Normally I would use 1 equals to 4 or 1 equals to 5. Okay, with a very small stop losses. Okay, it all depends on you guys. Okay, I hope you guys understand. I will do another video in the future how to draw a support resistance, how to draw a trend line. I hope you guys stay tuned. If you like the video, don't forget to subscribe, press the button like, and leave a comment down below on what topic you want me to do a video. I hope you guys understand. Don't forget to take a note on everything that I just told you. Okay, don't forget to take, to absorb, and apply. I wish you guys all the best. See you guys on the next video.